Uh, with us today is Mr. Bobby Barnes. He's with John Hancock Investment Management. And Bobby is going to enlighten us today on his firm's economic outlook for the year, as well as the investment outlook. So you're going to couple those two together. We'll probably go about a half an hour or so with that part of the presentation. And then I'm going to switch gears a little bit, and I'll take probably 15, 20 minutes or so to discuss the key components of a solid financial plan and how, when you have those key components in place, I feel personally that it can actually reduce the stress levels in your life, knowing that there is a ship headed in the right direction and you are at the helm and you're steering it. So that's what we have on our agenda for today. Like I said, that should last about an hour, a little bit over an hour or so, and then we'll get you ready for a happy hour and on to your dinner plans for the evening. So let's do a little housekeeping at the beginning here. First of all, many of you know Lisa LaPlante. She's my operations manager, so she'll be on the call this afternoon, as well as my paraplanner, Michael Whitney. They will both be on the call today. So if you have any questions, you have any problems, technology problems, or just simply a question that you want to ask, you can get in touch with Lisa or Mike at 518-786-3300. That's the office phone number, and we'll get you patched over to Lisa, or any email questions as well. So Lisa is LaPlante at albanyfinancial.com, and Mike is M.Whitney at albanyfinancial.com as well. And a couple different ways that you can get in touch with us. Just a couple more items. Like I mentioned, the presentation is being recorded today, so you're well aware of that. And lastly, I just want to leave you with the thought of, continue to look for additional videos like this, webinars, the newsletters that we send out, and actually the occasional podcast too that will be coming out from our office. And it's really just an attempt, again, to keep you well informed, to keep all clients and folks that are interested in this, these topics well informed, and then help you make smart decisions with your money. Because at the end of the day, that's what it's all about. So without any further housekeeping notes, why don't we get started and jump right in? So I want to introduce our first speaker, and we're very privileged to have with us this afternoon, again, Mr. Bobby Barnes from John Hancock Investment Management. So we've all heard the name. John Hancock is a legendary name in the financial services industry, and they have, over 120 plus years operating in North America and in Asia as well. So well-respected name in the financial services community. Bobby personally has been with John Hancock in various roles since 2005. He currently serves as Senior Vice President with John Hancock Investment Management. Is consulting with currently over 4,000 financial advisors in New York. That's quite impressive, Bobby. You must be busy on the road constantly, so good for you. Good for you. Prior to moving to his hometown of Buffalo, New York, in the fall of 2021, Bobby spent 14 years wholesaling in the state of Michigan. He holds his Series 6, 63, 66, and 7 licenses, and as well as a state insurance license. Before joining John Hancock, Bobby graduated from the University of New Hampshire with a degree in business administration and was a 4-year member, this is impressive, a 4-year member of their NCAA Division I ski team. He currently resides in Orchard Park, New York, with his wife, Christina, and his children, Emma, Caroline, Drew, and their puppy, Yodi. Did I get that correct, Bob? Yodi?
It's a mouthful. It's a lot to say about very little accomplishments. So
You're too modest, Bobby. You're too modest.
Yeah,
So I'll let you take it away from here, okay?
awesome. I'm grateful to be here today, and thank you to you and Lisa and Mike for setting this conversation up. I'm going to share my screen for everyone. I think everybody should be able to see my screen now. Just give me a thumbs up if it's coming up for you, John.
Yeah, looks good to me.
Great, thank you. So to kind of set up what we'll talk about today, I'll use a story from one of our past presidents, Ronald Reagan. There's a great book my dad gave me called Rawhide Down. That was his Secret Service nickname or code name that they used for him on the radios was Rawhide. And the day that there was the assassination attempt made on his life by John Hinckley was shortly after a particularly contentious election in the United States. And he was going to speak to the AFL-CIO in Washington to try to mend some fences. And he used this story that I think is appropriate for what we're going to try to do here today. He recounted when he was a young actor living in California, he was a real big baseball fan. And the announcer from one of the local teams invited him over to the house of a young ball player for dinner. And so this is in the 50s. And like you might imagine, you've got Ronald Reagan and the team announcer and the young ball player in the living room having a conversation, likely having a cocktail or two. And the ball player's wife is getting dinner ready when their young child starts to cry. And the wife says, "The baby's crying, can you change his diaper?" And the ball player says, "I'm a baseball player. I don't change diaper." Mind you, this is the 50s. I can't imagine getting away with that here in Orchard Park these days. And his wife said, okay, great. And she brought a diaper out and she opened it up and she said, "What you do is you put the baby's butt on the pitcher's mound. You take home plate, you wipe that, you bring that up to second base. You take first base, you put that over to the pitcher's mound, and you do the same with third. And in this game, if it starts raining, you don't quit, you start all over again." And my goal in these market updates is to speak to you in a language that you can understand. And in the next 20 minutes or so, my goal is to have you walk away feeling like John and I did our best to inform you as to what we see as the risks and the opportunities as they face us today in the market. And so to do that, I'll leverage what we call our John Hancock market intelligence. Now, if you love reading about the markets, or if you have a hard time falling asleep at night, this can be a great resource for either thing. If my presentation doesn't put you to sleep, apparently you can put it on record, put it on in the evening and fall asleep to it then. It can be useful in more ways than one. So we're going to walk through this book, which is our outlook, to give you that sense of what we see going on. But before we get to this year, I think it's really important that we reflect back on the year that was in 2022. And this is a visual that stunned me the first time that I had the opportunity to see it. What you see here are returns on the S&P 500, the largest 500 stocks in the United States, 10-year Treasury bill, that's 10-year debt of the US government, in a blend of the two. It's 60% S&P, 40% debt of the US government. And you can see that last year, that kind of portfolio would have been down 17.5%. And that 2022 was the most challenging year for that 60-40 blend since 1931. And so as you look at your statements, or as you have a conversation with John or Mike and you do a review, last year was just a historically challenging environment to source returns. A couple other things you'll notice is we've had 2 consecutive negative years of returns on the 10-year Treasury. That's happened 2 other times in the mid and late 1950s. Well, what you'll notice, and there's a little bit of a foreshadowing of some comments we'll share, that hasn't happened 3 times in a row, at least going back to 1928. So I think it's important that we take pause. We kind of consider what happened last year, some of the volatility that we went through in the context of where we're going. Where does the outlook that I'm going to share with you that we produce as an asset manager at John Hancock, where does that come from? just spend a minute here highlighting how we build our views. What a lot of folks might not know is that John Hancock, we're part of a global organization called Manulife Investment Management. And we're fortunate to manage $750 billion in assets. The scale means we can tap into incredible amounts of resources to help you with investment decisions. We have over 600 investment professionals across 5 continents who regularly provide insight that help inform our views, portfolio managers and analysts and economists who give us regional intelligence and top-down views that we can then bring to you. All of this thought diversity contributes significantly to building our views and sharing them with you, as well as the advisors I meet with. And what you're getting a peek into today is really, if I came in and sat down with John and visited, what our conversation would go into. So building on the importance of that thought diversity, which we find key, we leverage the resources of Manulife, which is our parent company, but we also have outside managers in areas where we might not have in-house expertise. That's what we're showing here. In fact, we have a large team of manager research and oversight experts who scour the globe to find managers who are the best at what they do, and then monitor them on an ongoing basis to determine if they're meeting expectations. And we work closely with that team to gain daily insight into the positioning of our portfolios. So the views I'll share with you today aren't singular in nature. More importantly, they're aggregated from a variety of folks and what I'll call, if I refer to, as the John Hancock Network. So we want to share with you insight from across that network. And the way to read the shading, if we simplify it, is bearish is we expect that specific asset class to underperform its historical returns over the next 12 to 18 months. Bullish is we expect it to outperform, and therefore would recommend overweight or leaning into that area in the portfolio. You'll see that our outlook is comprised of 3 sections. We'll talk about the United States. We'll talk about non-US stocks outside the US and fixed income. And on this illustration, what you'll see is to begin each section, we share our views. Globally today, you can see we prefer US equities within a portfolio. And that's shown here in our view over towards bullish on US stocks. Specifically in the United States, we're favoring large and mid-cap stocks. A little bit less so today on the small cap side. Why is that? You'll see on the next slide that we're likely headed into an economic slowdown. There are 2,000 stocks in the Russell 2000 index, and that's the small cap index. And 50% of those stocks are not profitable. So when we're headed into a potential slowdown in the economy, moderating our exposure to small caps is very key. So we believe that valuation is risky coming into this year. And what does valuation mean? That the market is a tad expensive right now. And what we use to gauge where the market is the leading economic indicators. And so these go all the way back over 100 years. But what you're looking at here is the last 52 years. And these leading economic indicators you can see on the right-hand side of the screen. The number 1 input is manufacturing hours worked. The number 10 input is unemployment claims. And if there's a little green bar going up year over year, that means in aggregate, those 10 items have grown. If there's a blue bar going down, that means in aggregate, those items have contracted. Typically, a contraction has preceded the last 8 recessions over the last 50 years. In November, the reading was negative 4.5%. In December, so there's a lag on the data. We just received the December data about a week ago. It continued down at about negative 5.6%. So that increases the likelihood of a recession here in 2023 in the United States. Typically, these leading economic indicators bottom out at about negative 10%. At the current trajectory, that puts us into May or June of this year. So if you're reading in the news, recession, no recession, these indicators would lead us to believe that we will see one at some point this year in the United States. I encourage investors as much as they can to tune out all the noise and just look for knowledge in the markets. So as we look to track what's going on in the stock market and key trends that are happening, we look at the leading indicators. Number 1, John mentioned, we talk economics. And number 2, we talk about the outlook for the stock market. And what the market tends to follow is earnings, right? What you see here on the screen in blue is earnings per share growth. What you see in green is performance of the S&P 500, whether positive or negative. And if we just boil it down to its simplest item, typically we'll do these kind of talks in restaurants, and I would say if we were going to put together a group to purchase a restaurant, one of the first questions we would ask is, are you growing profits or shrinking profits or losing money? And that would inform a lot about the price that we would pay for that restaurant. Well, the stock market's the same, right? And so you see that we expect earnings to grow at about 5% here in the United States this year. And what's changed a little bit is a lot of earnings growth was driven by IT or technology companies for the previous 5 or 6 years. And you can see here, consumer discretionary, industrial, financial companies are at the head of the pack. One of the leaders, the leader last year was energy, with some of what went on in oil prices. And you can see that there's negative earnings expected this year there. And so what we're recommending, a little bit of caution, maybe leaning a little bit more into those consumer discretionary areas. Healthcare, although some negative earnings, looks a little bit attractive to us as well. What's an area of the market that may be providing an opportunity today as we see it? And that's mid caps. Mid-sized stocks in the United States, you can see here on the screen, got to the same price to earnings ratio as they did all the way back in the global financial crisis of 2008. They got down to trading at about 9.8 times forward earnings. And this year, mid-cap value stocks are expected to grow their earnings at a little over 4%, just about one of the best in terms of what we see. So what do we like in the US today? High quality large cap stocks, mid-cap stocks, and particularly mid-cap value is what we would recommend leaning into in the portfolio. And this is great because bear markets can be challenging. We're living through that bear market. I showed some of the returns from last year, but what we do here is go way back to the 50s, and we look at the last bear markets that we had. 11 times we've had a bear market since 1950. And you can see the peak to trough decline here, 20%, in some cases 33%. But if you look out 1 year from the bottom, on average, you're up 39%. 3 years from the bottom, you're up an annualized 15.5% on average. So if we get continued volatility in the market this year, this is something to remember. The US stock market is one of permanent advancements and temporary setbacks. And the only thing that can make that temporary setback permanent is making an emotional decision during a bear market versus what John, I know, will get into, which is creating peace of mind and confidence through that financial plan. As we look at international, and that's stocks outside of the United States, you can see here that we are expecting them somewhat to underperform their historical returns. And you can see that represented on the screen in terms of a bearish lean across the board. Why is that? Well, if you go back to those two E's, economy and earnings, what we're looking at here are purchasing manufacturers indexes from outside the United States. And the purchasing manufacturers index is when economists go to factories and ask questions like, are you hiring more people or less people? Are goods orders that you're putting in getting more or less expensive? Are orders for the good that you produce going up or down? We're trying to get a gauge on economic activity via manufacturing, and it tends to be a good leading indicator. If that readout is above 50, that means economic activity is accelerating. If it's below 50, it typically means it's decelerating. And on the screen here, you can see outside the United States, most of the major economies are decelerating. That's one reason for our underweight to international stocks. The second is earnings. As I mentioned, markets and performance tends to follow earnings growth. And what we can see here on the screen in front of us is negative earnings growth expected at about 2.48% from MSCI EAFE. What is MSCI EAFE? That's developed Europe and Japan. The other big market out there is emerging markets. That's the Chinese economy. And we're expecting some more growth. There's some reopening going on there, which is positive, but at 3.69 expected in 2023 still less than the United States. What is it all going to come down to? The dollar, the value of the dollar. And when I was growing up here in Buffalo, you could always tell how strong or weak the dollar was based on how many Ontario license plates we had at the local malls. If the dollar was weak relative to other currencies, you'd see a ton of license plates here. If the dollar was really strong, you wouldn't. And if you go back to about the middle of last year, the dollar got as strong as it's been in 20 years relative to currencies outside the world. That creates a challenging environment to have performance of equities outside the United States when the dollar is increasing in value. We've seen that change. We've seen the dollar roll over. Some of that is due to some of what the Federal Reserve Bank is doing on our interest rates relative to what the Europeans might be doing to quell some of the inflation challenges they have over there, but keeping a close eye on the dollar, because if the dollar continues in a downward trajectory, that will be the positive sign for owning investments outside of the United States. Everybody's favorite topic, this is certainly a four-letter word. From last year, we showed some of the really challenging returns on bonds and fixed income. You can see overall we're neutral there. What do we prefer? To put it succinctly, we're recommending overweights to your high quality bonds. That's going to be mortgage-backed securities, investment-grade bonds, and municipal bonds, those high quality bonds in the United States. Why might that be? Well, last year was somewhat of a historic year for the Federal Reserve in the United States, raising rates from near zero all the way up to 4.5% where they are today. You'll see in the news this week, they're expected to raise rates again up to 4.75% by a quarter of a 0.25% of a basis point over the course of this week. And then they're expected to get the federal funds rate to 5% and then pause. You can see that on the left-hand side of the screen. All of this done to try to quell some of the inflation that we saw in the reopening after COVID. That leads to something we call an inverted yield curve. And that historically indicates a policy mistake. Prior to recessions, the yield curve inverts. What does that mean? That means interest rates on short-term debt is higher than interest rates on long-term debt. Historically, this green line on the screen, you would expect to be going up like this, where short rates are higher than long. That's a sign of economic growth out into the future. When the curve is inverted, it means people are wary of future economic growth. That's the situation that we find ourselves in today, is an inverted yield curve. Why do we want to be in higher quality investments? Well, what we did is we did a lot of research, and we went back and we looked at the last 3 recessions we had. The recession that we had during the dot-com bubble, the global financial crisis, and then the COVID recession. And we looked at yield curve inversion date, when did short rates get higher than long rates, to the end of the recession. And we wanted to see where were the best places to be invested during those periods of time. And what you can see is on average, intermediate core and intermediate core plus bonds were the best places to be. That's the reason for our overweight into intermediate, high quality US bonds as we head into the environment that we're in this year. You may mention a slide or remember a slide from a little bit earlier that I showed you showing that mid-cap stocks got dropped to about the same forward PE ratio as they did during the global financial crisis. Well, last year, something similar happened on corporate bonds in the United States. On high quality bonds, they got down to trading at about 85 to 90 cents on the dollar. Bonds are issued at par. They can trade at a premium to par. They can trade at a discount to par. And because rates went up last year, bond prices were inversely affected. And you saw a lot of high quality bonds trading at a discount, which drove up the yield to maturity in the neighborhood of 4.5, 5% on some of these bonds, making them even more attractive today. As we look at things and say, okay, we're buying of this basket of securities at a discount to where it was issued, with one of the more attractive yields we've had in quite a few years. So that's our reason. You can see here on the top of the screen for a bullish outlook on high quality debt of corporations in the United States. A little bit back to that behavioral finance theme I mentioned in the middle, and this slide illustrates the importance of what John does. I think it relates the importance of what's been my life's work since 2005. And this slide, if I'm being very honest, really is a bummer. It's a real bummer, and I'll tell you why. What we're looking at here, going back to the year 2000, the last 20 years, these gray shaded areas are recessionary periods. Typically during those recessions, we see market bottoms. For instance, the market bottomed on March 9th of 2009 during the global financial crisis. The market bottomed, I believe, on March 24th of 2020 during the COVID crisis. I'd have to go back and double check that. These green lines that you see here are cash levels. And what we see every time we have a recession and the market bottoms is new highs in cash out of the market. And the best thing to do, as Warren Buffett said, would be fearful when other people are greedy, and greedy when other people are fearful. And from what you can see here today, a lot of investors do the opposite. That boils down to the massive importance having an experienced professional like John between your money and your emotions. And we can provide you with reams of data that back that up. So to summarize some of the comments, where do we want to be? High quality stocks, value and defensive areas of the US market. As I mentioned, we think mid caps remain attractive as an investment. Higher quality defense on the international side. We've seen some abatement of those macro headwinds, but we still believe there's more risk and exposure to cyclicals outside the United States. And then the highest quality for fixed income. As the economy decelerates, finding value in the higher quality parts of the bond market, particularly high quality US corporate debt, is where we recommend you be. So that's my prepared comments for today, John. I'm grateful to everyone for tuning in. Hopefully we accomplished the goal we set out to do, which is try to speak to you in your language and have you walk away from this conversation feeling like we did our best to inform you on the current state of affairs and risks and opportunities.
Thanks, Bobby. Yeah, that was a really super overview about what's going on in the economy, your firm's thoughts on investments, sectors, pockets of opportunity, for sure. So thanks for all of that. Well done. Lisa, do we have any questions out there? Anybody get in touch with you regarding something they had for Bobby?
I'm not seeing any hands raised.
Okay. All right.
Put them all to sleep, Lisa. Is everyone asleep?
Well, wait till they get to my part here, Bobby. So, but while we're waiting for somebody, maybe that may have a potential question, I want to just pose this to Bobby and get his color commentary on it, so to speak. Maybe you can elaborate a little bit more. But what you've presented from the economic viewpoint, I think it's important to point out to everybody on the call and just everybody in general that bear markets and recessions are really a normal part of our country's economic cycles. Okay, it's happened throughout history, and it will continue to happen, and that's just the way our economy works. So, Bobby, any additional thoughts on that as far as, yeah, we're experiencing these things, but, honestly, we've seen them in the past. They'll continue to come in the future. And maybe, it's just time for a big, deep breath.
Yeah, 1 out of every 4 years tends to be negative in terms of return. And we want to anticipate volatility in the market, right? Tends to be volatile both ways. People don't think about it this way, but if the market goes up 30%, that's volatility. It's just in our favor. So
yeah, that's right.
Historically, the market's been volatile. That's where your asset allocation really matters. That's where having a portfolio that matches the risk tolerance and goals that you set up matters. And that's where, not to steal your thunder, John, but
No,
my
please
wife and I
do.
have an advisor, and when we visit with our advisor, is less about where the market is and more about if we're on path to meet our goals. And John mentioned we have 3 young children, and our overriding goal right now is funding what will be a likely very expensive college experience, hopefully for them. And so, yeah, absolutely. And in my ski racing time, we did a lot of inspecting of mountains. So when it came time to race, the plan took over and the fear didn't take over. And there's so many parallels to living in retirement as well.
Thank you. Well said. Well said. Lisa,
We
looks
have a
like
question coming in
yeah, sure.
from Rick.
Okay.
Go ahead, Rick.
Hey, Rick.
Hi.
Hi.
Quick question. I really like that chart you started with the S&P 500s and the bonds and the blend. Is there a place I could look up a chart like that myself?
Yeah, I can send it to John and Lisa for you. I think.
Is that compliance approved for the general public, Bobby?
Yeah.
Okay, good.
They just sent it to us to disseminate out.
Yeah,
so I can email that to you right now, John.
Yeah, send it to me and I'll get it to Rick or whoever else wants it. Sure.
Yeah, and then Rick, we found it from a gentleman by the name of Charlie Gigliello. He's a gentleman that does a lot of charting and Outlook online. And so he's on there as well. But I just emailed that over to them. But if you go online and you look up Charlie Gigliello, Bilello, you can get a publicly available version of it.
Okay, great. Thanks. That was a very interesting look, especially the overall percentages up and down, because it's been a tough couple of years, and I am a patient person, so it's good to see that there are ups and downs. But yeah, that was a good chart. I like that. Thanks, Bobby.
Thank you for joining us, Rick. Appreciate it.
Also, go Bills.
Yeah, they went. All right, man. Not that it made me feel any better watching what Kansas City did to Cincinnati on Sunday, but I don't want to drag everybody here through my.
Yeah, I know.
Well, as the commentator said, the road to the Super Bowl for the foreseeable future is gonna run right through Buffalo. So no worries there.
Let's hope.
Bobby, Lisa, any other questions at this point?
No, not at this time.
Okay, Bobby, I just had one more observation for you, and then maybe you can just give me a quick comment, and I'll get into my portion of it. For years and years and years, you have client meetings and you have discussions with clients about their target asset allocations and diversification and things of that nature. Right? Fixed income bonds always plays an important role in that. And, part of that conversation is due to the fact that, fixed income bonds tends to be the anchor, right? In a down, in a bear market, and they tend to hold their value and even, add value, hopefully, to a certain degree. Well, 2022 was a bust for that, boy, right? And the returns on even high quality securities there were quite staggering there for a good part of the year. And it's important to remember that inverse relationship that you mentioned, very important. So when, when the interest rates keep climbing, the value of that bond is going to fall. So I noticed on your outlook, it seems like this coming year, or maybe the next 18 months, we've seen such an increase in interest rates last year and the first part of this year, quarter or half year anyway. It seems like an environment that's ripe really for outperformance coming in the next year where, inflation starts to drop. The Fed takes their foot off the gas as far as interest rates are concerned. They start bringing those rates down again and the values of those bonds going up. But your firm is still a little bit cautious on that. It is positive territory, but how do you see that playing out in the next couple of years or so?
Yeah, I think about it this way, and I think that's the key question is, as you sit down and develop an asset allocation, relying on the inverse relationship between bonds and stocks is a cornerstone of building an investment portfolio and going forward. And if we look back over 2022 back to 1928, we're looking at roughly 96 years of history. Over that period of time, by my count, there's been 26 years out of 98 where the S&P has provided a negative return. That gets back to our earlier comment of 1 in every 4 years tends to be a negative one, but sometimes they can come in a row. 5 of those 26 times, bonds have also been negative. The same year the S&P was negative. So up 19-ish% of the time. So 80% of the time when stocks go down, bonds go up. Historically, when the curve inverts and the market gets choppy, core high quality bonds are the place to be. And that's part of the reason why we feel that way, because 80% of the time that relationship holds up and does provide the diversification benefit that's so crucial to dampening volatility in investor portfolios. And so if we're looking at it kind of objectively and just looking at the math on it, and I've got an 80% chance the relationship will hold up and about a 19 to 20% chance it won't, I'm going to lean into staying allocated and even increasing some allocation as we see it today to core and core plus bonds. So, okay. Yeah, I would say, the reading through the lines on our book and what we take away is a conviction on U.S. mid-cap stocks, or a pretty clear conviction, and a clear conviction on high quality U.S. bonds. Everything else, it's a challenging year.
Sure.
If we talk to market strategists, market and economists, it's a very difficult time to forecast what's going on, because we're in somewhat uncharted territory with inflation, the stimulus from COVID, and what the Federal Reserve is doing to try to back down some of that inflation. So a lot of that interplay, we'll see how it shakes out this year, but we would err on the side of more conservative in our.
Okay, sure, makes sense. I understand. Got to kind of keep things close to the vest right now. Oh, okay, very good. Again, thanks very much for your analysis and your kind remarks for our group. Appreciate that very much.
Thank you, John.
Sure. So what I'll do now, Lisa, assuming no more questions at this point for Bobby.
No more questions.
Okay, good. So what I'll do now is then I will just pivot, and we'll get into a conversation about really the merits and the advantages of having a solid financial plan in place. So we do have a couple guests on the call this afternoon. Welcome. For most of you that we're currently working with, we have comprehensive financial plans in place. For those of you that don't, I would urge you to give us a call here at the office and allow us to do that for you. Because as important as it was for Bobby to present his analysis and his firm's analysis on the forthcoming 12 months or so, I think equally and honestly, more important in my mind is again, the preparation of a comprehensive financial plan, having a plan in place, guidance, and it's monitored and revisited at least annually to make sure that you're still on track to meet the goals and objectives that you've set forth for yourselves. And everybody's different. So please get in touch with us if that's something that interests you, and we'd be happy to spend the time and start to construct that. What I'd like to do is I'd like to go over the 6 or so key components of a financial plan and just give you a couple bullet points from each category of the things that we look for, the things that you should be looking for, and the questions that you should be asking yourself in case I don't cover it in detail today, but these should be top of mind for everybody on the call, quite honestly. So the first area I want to talk about is cash management, everyday cash management, right? And 2 or 3 years ago, the the topic of managing your cash was really not a point of conversation, right? Interest rates were 0.25%. You were getting pennies on interest on your savings accounts, things of that nature. Now times are different. Everybody's familiar where interest rates have gone and where looks like they're continuing to head for the near term. That means that managing your accounts, your cash, your savings, your checking, your money market accounts is extremely important nowadays. So I would urge you to do your research. And if you have which is very important, you should have in a cash management strategy, an emergency fund, a rainy day fund where you can go into liquid fund that you can go to for true emergencies. That's an area that you should have, you should be getting some pretty decent interest rates on right now. So cash management, really important from the income side, right? From an expense side, what we look at extremely closely, and I think this is the key really to a successful financial future. And one area, honestly, that I don't see a lot of advisors taking the time to really grind out the details is cash flow. Is your respective cash flow in the household? It's pretty easy to tell where the money is coming into the house, right? It's much more difficult to figure out where it's going, right? So we have some pretty good techniques where we can identify a client's cash flow by identifying those major expenditures and then working backwards from there. So an important part of any comprehensive financial plan, in my opinion, is cash flow, to really dig deep into those numbers. Again, the cash flow statement is looking at the money coming in, the income, the expenditures going out, expenses. And either at the end of that certain time period, you're in a surplus position or you're in a deficit position. So we're all hopefully at the end of the month, we have a little bit of a surplus of cash flow. You'll notice on a cash flow statement that there are several different components to it. Again, it's really important to get the detail as much as possible. And we can do this again without having you fill out a tedious budget. Nobody loves to fill out a budget, right? I would never ask you to track how much you spend on a daily basis for the next 2 months, because most of you, myself, quite honestly, would never do something like that, right? So we have a realistic method for helping you out with that. I mentioned short-term savings versus what Bobby was talking more about today, long-term investing, right? Short-term savings, those short-term areas that you know you're going to need cash perhaps in the next 6 months, the next year, maybe 18 months or so. So you can't take a lot of risk with that. You want to make sure it's conservatively invested in typically bank products, right? To get that FDIC, that all-important insurance. So I would say check your rates. If you know you're going to need cash, not for another time period, 3, 6, 9, 12 months, check out those CD rates nowadays. They're quite startling to where they were 18 months ago. Cash management, very, very important. Debt management, the second component. Again, it's an area that is quite frustrating for a lot of people, and they build up debt over the years because they don't have their cash flow dialed in properly. So the debt mounts. I've always maintained that there is good debt and there's bad debt. So I think debt can be used just as a carpenter uses a hammer, just as a tool. I would consider good debt to be something like a mortgage, in essence, that you're taking it out on a very important asset, perhaps the largest asset you'll ever have in your lifetime, and that asset tends to appreciate in value over time, right? So a mortgage would be a good example of good debt. The flip side, bad debt, of course, the number one enemy there would be credit card debt, right? To rack up large amounts of credit card on fairly disposable items, right? House is going to last you for 30 plus years at least. but those credit cards you're buying, sneakers, jeans, whatever the case may be, they probably won't be around that much longer. All right. So, and then of course, the interest rate on credit cards, astronomical. Good example of bad debt. There's a famous radio personality, Dave Ramsey. Some of them, you folks may listen to Dave, and he has an interesting strategy. I think he's just a big debt guy, and he has a debt payoff strategy. It's kind of like a snowball strategy, I believe. I don't listen a lot to Dave, but from other folks that have listened to him, he's a big proponent of paying off smaller debts first, interest rate debts first, lower balance debts first. Get some confidence, get a game plan, get some confidence that you can do this, and you're starting the strategy of paying debts, and then you successfully move on to larger and larger debts with larger interest rates. There is the opposite school of thought as well, is trying to attack debt from the highest interest rate perspective as well. So again, I think that's unique to each individual, but something that again is a key component for a comprehensive financial plan. Next area I'd like to talk about is, excuse me, risk management, what we call risk management, but it's basically all about insurance. Okay, so insurance, of course, is the necessary evil. Nobody wants to really spend a lot of money on insurance, but of course, we all know the worst time to possibly buy homeowners insurance, as an example, is when your house is on fire. So insurance is that necessary evil that for the right people, we have to have that risk management tool in place. So I think three questions, if we're talking about life insurance, strictly, three questions that you need to ask yourself. First of all, whether or not you need it. Okay, typically a young couple with a young family is a prime example of folks that need life insurance, right? When others are dependent upon you for a source of income, right? That's when you need insurance to cover any catastrophic types of events. So a young family is an ideal example. However, on the flip side, maybe a couple that the kids are married on their own, they have their own jobs, and they're very successful on their own. Maybe the couple has a nice nest egg built in over time, perhaps maybe a pension or something like that, Social Security. They may not be candidates for life insurance anymore. So we have a couple clients right now that we're doing life insurance reviews for, and it's something that we see quite a bit. So first of all, whether or not you need it. Second of all, if you do need it, what type of insurance should you have? Two basic types, permanent insurance and term insurance. Permanent is going to be out there forever till the day you die, as long as you keep paying those premiums. Term insurance, just as the name suggests, is for a finite period. Okay, there's times and uses for each one of those. I think for the vast majority of folks, term insurance is the cheapest, it's the plain vanilla, and it gets the job done more times than not. So insurance, extremely important risk management. Of course, your homeowner's insurance, your car insurance. That area is so competitive nowadays. You really should be shopping around probably every 3 to 4 years. You should get quotes on your homeowners and auto insurance. If you bundle, you should be bundling those, and get quotes from a lot of different insurance carriers, because again, it's so competitive. If you haven't thought about liability insurance, you may want to ask that an umbrella, it's called an umbrella policy. Ask the insurance person about that as well. And again, that's just to cover any catastrophic liabilities that may occur that your other policies may not cover. Okay, prime candidate would be myself, quite honestly. So we have a pool and we have dogs. Okay, two liabilities right there that could come up to literally bite somebody in the rear end someday. So it's important that we have liability umbrella insurance policy, and my wife and I do have that. Getting into the next area, retirement and investment planning. Of course, this is the area that everybody thinks about. and on the topic of a lot of folks' mind, and rightly so. Again, in the last year, as Bobby's pointed out, and we all know by now, the investment climate has been extremely difficult in the last year. So a lot of conversations revolve just around the investment planning and the retirement planning as well. So of course, the key components of any solid investment plan would be, of course, to keep in mind your asset allocation, your target asset allocation, which we revisit at least annually with our clients. Again, you have that big conversation. What do you feel comfortable investing in the equity, the stock markets? What do you feel comfortable investing internationally, in the fixed income markets, bond markets, and such? So asset allocation, extremely important, which gets into diversification, right? That's why we have all of these different asset classes, because again, we don't want to, as the saying says, put all of our eggs in one basket, because we know what could potentially happen if we drop that basket, right? So we have exposure to a lot of different asset classes. Diversification, really important. Risk tolerance. We should be having conversations periodically about your risk tolerance. It's important to not get too conservative in retirement, because honestly, inflation, for any retiree, inflation is going to be their number one enemy over time. And my gosh, we've seen that in the last year or so. So risk tolerance, if somebody feels they're more ultra conservative, I may have a conversation, Mike may have a conversation with them to try to educate, to move them, at least to get them thinking a little bit more differently about that whole area. So risk tolerance is important as well. These are all key components of a successful long-term investing strategy. I'll keep in mind, point out to you, investing, as we do it here at Albany Financial Group, is long-term in nature. Okay, we're thinking strategic down the road versus short-term, which is more speculation. Okay, tactical in nature. And I'm not saying that's necessarily wrong. If you have some play money, so to speak, that you like to jump in and out of pockets of opportunity in the markets, I would say, have fun, but that should not be your retirement strategy for the long run. So that's what we focus on here at Albany Financial Group. I would say one other important part of a financial plan in the retirement part is, again, that cash flow is extremely important, but we do an analysis called Monte Carlo analysis, and it's really based on probabilities. And what we do is, through a Monte Carlo analysis, we run 1,000 different iterations of somebody's financial plan, giving all different rates of return from the markets. Okay, so our software is able to do that, run a Monte Carlo, given extreme down market conditions, given moderate conditions, and given really good performing market conditions, and to see how the plan holds up. It's basically a stress test. Okay, so really, really important Monte Carlo analysis, and again, an important part of any sound structural comprehensive financial plan. The next area is overlooked honestly by many advisors, because I think they're just afraid to go there, but we're not. We actually pride ourselves on tax planning. So again, I've been doing tax preparation for 30 years or so. I've drifted away from that. I'm getting out of that business. That's become a full-time job in and of itself with all the tax law changes. So I'm handing that off to other professionals. But tax planning going forward, proactive tax planning, we are proud of our services there. Especially in retirement, distribution plans. So you've built up these nest eggs over time and you retire. Now you need to start drawing from those assets. What's the optimal strategy from a tax perspective to draw on those nest egg assets, draw on Social Security, claiming strategies, again, very important, retirement or qualified or tax deferred or tax free types of investments that you may have. How does that plan out from a distribution point of view and the tax efficiency of all of that? So I think tax planning is critical in retirement. Roth IRA conversions, does that make sense for people to think about? Tax loss harvesting, many of the clients on the call today, we've interacted with, especially at year end, extensive conversations about that, things of that nature. Tax planning. Have you inherited property lately, whether it's an IRA or it's a non-qualified type of account, or it's annuity or land or property? You have to be cognizant of the tax basis of all of those different types of assets that you may have inherited. Loss carry forwards, the list can go on and on and on. So again, we feel strongly about our tax planning services here at Albany Financial Group. The last area that I would mention today is, again, critically important, and I find that many clients, their knowledge level is not very high here, and quite honestly, they're not prepared. They are just not prepared for their eventual estate. So we're talking about estate planning here, and I think it's critical that everyone have a basic estate planning system in place, a basic estate plan in place. So we're talking about a basic will, powers of attorney for somebody that you trust to make financial decisions on your part in case you are incapable of making those decisions, healthcare proxies, a living will from a medical perspective. Whether or not you can make those decisions, that's when those folks would step on from a medical point of view. Those areas are just critical, because if you die intestate without a will, then unfortunately the state is going to step in and make a judgment call about who is going to handle all of those affairs for you. It's not overly expensive, folks, to get a basic estate plan in place. So I would urge that. The probate process. Again, a lot of folks are just quite confused about the probate process. So I think that goes hand in hand with the way your accounts are titled. And it should also go in hand with your beneficiary designations. So those of you that have IRAs, insurance contracts, annuities, life insurance, 403b, 401k plans, those are all what are called qualified assets in the eyes of the IRS. They have beneficiary designations. Everybody should check their beneficiary designations on those types of investments that I just mentioned, because it's those designations and not your will, okay, who are going to determine who inherits that asset when you pass away. Extremely important. For other assets that don't have beneficiary designations, for instance, just a checking account that's titled just in your name, okay, that will pass through your will. So you're going to name who is going to receive those types of assets in your will. And again, wills are subject to probate many times, sometimes not so much, but many times they are. Attorneys involved, potential higher fees involved depending on the complexity of the estate. So again, these are things that you just want to have a solid plan in place. Speak to an attorney. I'm not an attorney. I'm not authorized to practice law, so I don't give legal advice, but I can certainly educate on the basics, as I've just done to a degree, about basic estate planning. So those are the key components of a comprehensive financial plan. Again, if there are areas here that I've mentioned that you're maybe scratching your head, or gosh, I really need to think about that, and there could be several others, you don't have that plan in place, I would say, please give us a call and we can certainly guide you through that. Okay, Lisa, any questions out there regarding what I've just presented?
There are no hands raised.
No hands raised. Okay. All right, like I said, most of the folks that we work with have plans in place, and others don't. So I would urge you to think about that strongly. Well, if there are no other questions, then I do want to respect everybody's time. So it's 5:06 right now, pretty good with the timing. And I think we provided a lot of value, a lot of information here for you today. Again, Bobby, thanks so much for your participation and your guidance with everything. And hopefully what I presented regarding comprehensive financial planning struck a chord with somebody, or at least the importance of maintaining and monitoring the plans that you do have in place currently. Any questions, of course, you know how to reach us, you know how to contact us, follow up with anything that may be on your mind. Before I sign off, I just want to thank everybody again for being on the call today. I want to thank you for your business and your trust. It means a lot to myself and my team that you believe in us, you have conviction in what we say, and you trust us. And that really means the world to us. So thanks again, and everybody enjoy the rest of their evening.
Thank you, John.
Good night, all. Good night, all.
Take care, folks.